Hi and welcome to the Got Money FX presentation on basic indicators. In this video we're going to look at a few of the commonly used indicators and discuss how to use them. An indicator is a tool that traders use to graphically represent what price is doing. Indicators fall into two broad categories. They are either leading indicators or lagging indicators. Leading indicators try to predict what the market is going to do next, while a lagging indicator confirms what the market has already done. Moving averages are probably the most widely used indicator. A moving average averages the closing price over a period of time and then draws it as a line. There are a couple of different types of moving averages: simple, linear, smooth, and exponential moving averages. They all calculate the average closing price over a period of time but use slightly different formulas. Let's have a look at the moving average on our charts. The first thing we need to do is apply our moving average indicator to the chart. We find our moving average indicator under Indicators on our navigator pane. Left click on the moving average indicator and drag it onto the chart. After applying the moving average indicator to our chart, a pop-up window will appear. From this window we can adjust the parameters of the moving average indicator. We can change the period that the indicator is averaged over. We can change the type of moving average used. We can adjust the price point the average is calculated on. We can adjust the color of the moving average line that is going to be drawn. We can adjust the type of line that is drawn, or we can change the thickness of the line that is drawn. After changing the parameters to suit, we left click on OK. If you wish to apply multiple moving averages to your chart, you simply repeat the process. Left click on the moving average indicator, drag it onto our chart, change the parameters to suit, and left click on OK. For my second moving average, I'm going to place a 20 period moving average on the chart. This time I'm going to change the color to red. The 200 period moving average is often used to determine the direction of the longer term trend. Smaller period moving averages, such as the 20 period moving average, which is drawn here in red, helps identify the shorter term trend. In this example, if we zoom out slightly, we can see that the longer term trend is heading down while the shorter term trend is heading up. Moving average crossovers are often used to calculate entry points. I will now change the two moving averages on the chart from a 220 period moving average to an 8 and 13 period moving average. We change the settings of the moving averages by double clicking on the moving average, changing the settings to suit, and then left clicking on OK. When the smaller period moving average, which is the 8 period, which is colored in red, crosses below the blue line or the higher 13 period moving average, it predicts that the market is going to go down. When the red line crosses above the blue line, it predicts that the market is going to go up. When using moving averages, we need to be careful of whipsaw. Whipsaw is when the market moves sideways, giving us many false signals. To reduce the risk of false signals, a trend indicator should be used in conjunction with our moving averages. This helps us to only trade when we are in a strong trend and reduce whipsaw. The Bollinger Band indicator draws three lines on our charts: two outer bands and a center line. When the bands are closer together, market volatility is low. When the bands are further apart, volatility is high. Bollinger Bounces and Bollinger Squeeze are two common Bollinger Band trading methods. Let's have a look at these in MetaTrader. To trade the Bollinger Band bounce method, we look for sell signals when price hits the outer band and buy signals when price hits the lower band. In this current chart example, we would have sell signals here, here, and here, and buy signals here, here, and here. The Bollinger Band squeeze method waits for periods when the market is flat and volatility is low. These periods are identified when the bands are flat or moving horizontally. Flat or horizontal bands predict a breakout. The longer the bands remain flat or horizontal, the larger the preceding breakout is going to be. The stochastic cross indicator helps determine overbought and oversold areas, as well as using the stochastic cross to determine times of entry and exit. In this example, the stochastic is drawn in red and blue lines. You can see how the stochastic fluctuates between the values of 0 and 100. When the stochastic is above 80, it predicts that the market is overbought and so should retrace or move down. When the stochastic is below 20, it indicates that the market is oversold and should start to move up. Stochastic crosses occur when the blue line crosses below the red line for sell opportunities or above the red line for buy opportunities. Just like moving averages, stochastic cross can also be susceptible to whipsaw. To reduce whipsaw, traders often only take stochastic crosses when they cross above the 80 line for sells or below the 20 line for buys. Divergence is a leading indicator used to predict the end of a trend or tries to predict that the trend is going to continue. Divergence is a little bit trickier to learn than the other indicators, but is definitely worth the effort. There are many different ways to calculate divergence. Got Money FX calculates divergence using price action and the OSMA indicator. Divergence and how to trade divergence is taught in a separate video presentation. Thank you for watching our video presentation on indicators. If you have any questions or would like to talk to someone about trading in general, please contact us at gotmoneyfx.com.au.